This episode of From Angel to Exit is brought to you by Align 5. Align 5 specializes in mergers and acquisitions for growth-focused entrepreneurs and family businesses. With decades of buy and sell side experience, they prioritize client alignment, avoiding conflicts of interest common in other firms. Align 5 delivers above average industry results by customizing strategies for diverse industries, ensuring optimal valuations and securing strategic acquisitions or exit partners. If you want to find out more, check out align5.com. That's align, the number 5.com. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. Welcome from Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today is Frank Williamson. He's founder and CEO at Oaklyn Consulting. We're going to have a really interesting conversation today, not only about the whole growth and exiting process, but really what happens in some of these portfolios when you have assets that are not performing as well, and we kind of need to figure out what to do with them. I think it's going to be a great conversation for folks that are thinking about exiting and really kind of understanding the other side of this. And when you're dealing with private equity and you're dealing with funds that are supporting or buying into these companies and becoming part of a portfolio and have expectations, like what happens with those expectations as companies kind of perform or don't perform. So excited for this, a little bit of inside baseball here on what happens on the investment banking side. So I'm excited to have the conversation, excited to be part of the conversation with Frank here to kind of get into this and understand what some of the history is and what some of the options are. So with all that, Frank, welcome to the program.
Bruce, it's great to be here. Thanks for having me.
Yeah, no, it's a pleasure. Before we dive into everything we're doing today, let's talk a little bit about your background. What is your background professionally? How have you gotten into this space? Give us a little bit of the backstory.
Okay. Well, I've been in some form of an investment banker for my whole career, which is 30 years or something like that now, from starting out doing an analyst job to going to do public company work. Spending some time, completing some deals for a venture-backed company, running a traditional boutique, and then for the last 8 years, running Oaklyn Consulting, which is a sort of a specialized kind of M&A boutique.
Okay. And give us, just so people understand, your role as an investment banker. I mean, I always kind of joke that it's really not about investment or about banking, but what what do you do? Like practically, what are you doing? With these companies, and what's what does the job actually look like?
That is a great point. I think that the thing to keep in mind about, well, as most of your founders know from raising capital, but also about selling companies or buying them, is it is a complicated year-long negotiation with multiple offers and counteroffers. What investment bankers do in that context is help to project manage that long involved negotiation, especially focusing on the financial parts of it.
Yeah. And any particular kind of focus, either in terms of industries or situation or sizes or geographies, like where have you kind of operated mostly?
Well, the reason we formed Oaklyn Consulting was to serve a part of the market that wasn't being well served, and that's relatively small, relatively complex deals.
Okay.
So the normal way investment bankers work is they charge a commission at the end of a 9 or 12-month project if they're being smart about their own business.
Yeah.
They're very careful about who they take on, right? Because you need a deal that's going to close on time and not be a time sink. We bill time instead of deal fees so that we can help the part of the market that's not otherwise well served.
Yeah.
So that's our world, is smaller, more complicated, usually meaning lots of social issues.
Okay.
I
always found I found this with my own company, and certainly several clients I've worked with. If you're under 50 million, And it's just tough, right? The bankers want to
That's
work.
right.
I mean, because they're taking a cut, like the same amount of work selling $100 million company as it is a $10 million company. I'd rather just go find a bunch of $100 million companies. What is that kind of size? Like when we talk about, or I don't know if you have any kind of models for kind of structuring, company size and the way the deals end up working, or, I mean, I know we go everywhere from like a business broker, all the way up to, big M&A shops that are doing
Yeah.
billion-dollar deals. Like how do you stratify the market a little bit?
I think that $50 million cut for enterprise, measuring on the enterprise value, is a pretty good way. It is a pretty good place to be. There are lots of people who serve sort of the middle market or lower middle market that want to cut off their project revenue at 800,000 or $1 million of fee.
Mm-hmm.
And if they're being smart, they're probably discounting that by half for risk, right?
Mm-hmm.
So they're saying, well, I need to make some yield on my time to get it done. And you're absolutely right. It's about the same amount of time, regardless of deal size.
Yeah.
Business brokers create value a little bit differently than you can think about investment bankers doing it. They create value by identifying the owners of relatively small businesses that want to sell and putting a listing for them in a place where buyers can see it.
Yeah.
Makes it much easier on a buyer who's looking to buy a business, right? Than calling everybody at any point in their career to see if they want to sell. But they're operating a business that looks a lot like real estate listings. And you can think about people who call themselves M&A advisors or investment bankers, doing something that, I guess the right analogy is, it looks like a real estate auctioneer.
Mm-hmm.
You're trying to get multiple people there at one time to make a bid, and you're reaching out to find people, as opposed to, kind of causing the company to show up at the watering hole where people are looking to buy things.
Yeah. Yeah, you kind of make the market rather than just kind of plug people into an existing market. And I'm just kind of curious, like what work actually goes into this? Like what's the actual heavy lift for an investment banker in terms of actually being able to find those companies, find the potential suitors, right? Manage the process. Like what's the hard part?
Yeah. I think the big thing that people can't do themselves is the role of being a Sherpa, for lack of a better term, down a year-long journey. The whole thing is a negotiation from the time you first raise with someone, hey, what could we potentially do together, until the deal is done. And the hardest parts of that negotiation are having more than one choice at the same time. So if you have more than one buyer, or if you have a buyer plus a good no deal option, but so you actually have choices. The next hardest part is keeping the thing on schedule, rather than being a forever conversation about how we could theoretically do something. And the third hardest thing is, once you've done all the work to negotiate a business deal, it's preserving value from the letter of intent, the business terms, to the closed deal at the end, and not having the buyer nick away the deal that you thought you had. Having someone who can see that journey ahead of time adds a lot for the typical founder. And so partially that's what the investment banker does. They're the guide for that journey. Second is they're the financially minded person who deals with company buyer types all the time. So they know the questions that need to be answered by a rational buyer, and they can help you early. Get your story in a row. You get your story organized so that the buyer can make a quick decision.
Yeah, this is interesting. And I'd love to get insights or things that you've seen. I talk a lot about things that are going to drive valuation, and then things that are going to make buyability. What makes a company viable, right? Because there's some things I find it's like, hey, it's a great company. There's underlying great fundamentals. There's great opportunity, but it is just not organized in a way and presented in a way that a buyer can see those things and actually. I mean, sometimes there's just structural things that they can't buy it, right? Like there's blockers in there that either prevent it or make it so complicated to buy that they just don't want to do it. They'd rather move on to another another option. What do you feel are some of the key things that earlier stage founder CEOs that are running some of these companies, things they need to think about in terms of what ultimately is going to drive valuation and drive kind of the ability to actually sell the company?
That's a great question. Well, when we talk with people, this doesn't apply to people who've raised money before and have
Okay.
outside investors, but if you think about owner operators,
Yep.
there are a lot of great jobs that are self-employed jobs. So they look like a company, but they're a job.
Yeah.
And actually, that's a lot of what business brokers are selling too, is opportunity to go do a job. You can buy your way into a set of customers and a brand and so forth, but it's really not a company you're buying. It's just the opportunity to have a job.
Yeah.
And so I would say, therefore, one thing is just think about whether whether what you're running is a job or it's a saleable thing. If it's a job, then use your profits to pack away savings and happily dissolve the thing when the time comes. Just don't even try to sell it, because just wind it down. If it's a saleable thing, then I think that the guidance is, again, this is not for people who've taken investment money from outsiders already. I think the guidance is, think about this concept of being an owner operator and start to get clear with yourself that there's an owner role and there's an operator role.
Yeah. And
the owner gets to sell the business. And so that if it's just you wearing that hat, it's you in the owner role that chooses to sell a business and when to do it and how to do it. And in an ideal situation, the operator doesn't totally know or care.
Yeah.
Now that's kind of at the extreme, but if we picture like you or me, Bruce, trading a share of Apple, it doesn't keep Tim Cook up at night.
Exactly.
If we rotated the owners in Apple, that's kind of the big extreme. With little companies, things are mixed together, even in the most stark difference. But the people who get really, really good at selling businesses do separate owner and operator with intention.
Yeah. I always say one of the tests I give CEOs is, it's like, okay, like if we put you on a 2-week vacation where you can't talk to anyone, what happens to your company? And if your company like basically dissolves, then you've got a job, right? If it has some semblance of, okay, we keep running. Yeah, exactly. If it can keep running, okay, maybe we have a sellable asset here, right? Like it's just kind of a litmus test of how well have you separated the ownership versus actually operating the company. So let's talk about the case where you now have investors, right? So for a lot of these folks, you've raised capital, and you've got a cap table, you've got people that have put money into the company. And, I always say if someone's going to put money into a company, they need to get it out at some point, right? Like they've got some kind of expectation. I guess when there is that expectation, or I guess how are those expectations set? How do you find, like when you work with companies with a cap table, like what is a process by which expectations get set about return of capital and timeframes and things like that?
Yeah. I think it gets set in the choice of the security that people are buying in with. So there are lots of people, for example, sort of local investors in different cities and towns, different places, who say back restaurant owners. They put in some kind of security that looks sort of like debt, and they expect to get cash back out of it over time. And what they're not looking for is some big hit 10 years in the future when they kind of declared victory and we're out. So you can think about it as, that kind of angel is looking to have someone build a great business and then they get redeemed out and everyone kind of declares victory out of that and they go on to recycle the money into something else. Those, by the way, are wonderful sponsors of small businesses all over the country and the world who are operating that way.
Yeah, but they're looking at some kind of annuity or some kind of distribution stream over time.
They want original cash plus something else. Back again. So they're looking at some kind of version of principal and interest come back. And then there are people who are investing into what's intended to be a saleable company, and they're not looking for cash back.
Mm-hmm.
They're looking for the sale of the company
Mm-hmm.
at some year in the future, which means that from day one, there is some level of discussion about I'm building a company that fits into some bigger organization's operation,
Mm-hmm.
who is presumably acquisitive. Um, and I'm moving along a path where the way that people get their money back
Mm-hmm.
is through a transaction event. Now, maybe in the really rare circumstances, it's going to be an IPO, but I think it's better to think about most founders who are building for an exit are exiting in an acquisition scenario.
Yeah. Yeah. And so they're realizing their equity value in some kind of payout and potentially some kind of retained equity or some kind of earn out,
Yep.
future value. And then the remaining people on the cap table are basically getting cashed out based on that transaction, and they basically recouping their capital so that they can reinvest it in whatever next venture they're going to do. And I guess tell us a little bit of difference, because people throw out, VC and private equity and all these kind of terms. Like, how do you see the differences, or practically what are the differences between having a venture capitalist on the cap table versus private equity? Like, how do those affect the dynamics differently, and what do they expect in terms of the outcomes?
So I think about an angel or a venture investor putting money in in which the money is mostly going to be used for sales and marketing.
Okay.
And you can think in a really mature situation, I mean, that what they're doing is just funding sales and marketing against some kind of product where there's a formula already that goes, if I put in this many dollars of marketing spend, I'll get this much more in terms of client contracts. And so you can think about that a lot with like software businesses, in which there's people can pretty well work out customer acquisition cost and lifetime value of a customer, and they can say, if I spend $10 more on CAC, I'm going to get $50 more on on long-term contracts.
Mm-hmm.
What's often called private equity is sometimes also called buyout. What people are doing in that case is buying a cash flowing business using as much debt as they can.
Mm-hmm.
But they are focused on changing the ownership, running the business well, maybe doing some other things that meet their skills, like buying more businesses to add on to it, and then selling it again later after using the cash to pay down the debt. What their cash is not going for is funding sales and marketing. The businesses you think about being sort of private equity acquired businesses, if it's being acquired directly by a fund, is that the cash is going to buy out existing owners rather than going into the company to fund sales and marketing. Operations are already funding sales and marketing at those companies. Now, I guess there's a third category that often gets called private equity, which is I've got a small business. I'm going to sell it to a larger business, which is owned by an institutional shareholder of some kind, probably a private equity fund. In that case, you're just selling to a bigger company. It doesn't totally matter to you day by day who owns the bigger company. Just you're providing something so the bigger company can say, look, is this going to give me new customers for my same products, or a new product for my same customers, and can I grow that way?
So if I'm say a professional services group and making maybe 20 million top line, right? We're doing well, it's growing. What are the kind of the avenues that I think about in terms of types of buyers and types of sales situations? Like what at a general level, what are my options? I guess that I would look at.
I think you've got three options to look at. Venture capital probably isn't one of them, because that really is designed for something where there's this recipe of sales marketing dollars equals more contract revenue, and you need the cash in order to keep going. What you've got would tend to be an investment fund if you've really hit a level of maturity, and your owner and operator roles are separate from one another. The owner sells to an investment fund that can keep growing it. Second, you've got a bigger, probably professional services firm, so maybe related product type business in the industry that you serve. And third, you've got some kind of financing structure that enables the people working in the business in the future to buy out the people leaving the business.
Mm-hmm.
And that can be financed a bunch of different ways, but often it's over time.
Yeah.
The predominant scenario is probably a bigger organization that's somehow strategically adjacent to what you're doing.
Yeah. So either you have a particular niche or a geographic focus or a set of customers that they want to bring in, or a capability that would add to their overall kind of broader offering, and it's kind of they tuck you in and continue to operate the business more or less as designed.
Right. I'll give you a great example that among some professional services firms that you and I both know that has come up is there is a private equity backed platform company whose business is providing management services to companies that are owned by private equity firms, right? Mm-hmm. So sort of, they've got a particular scale and style and so forth, and they offer sales, temporary sales management, they offer marketing, they offer back office support, they have kind of a whole suite of business administrative functions on an outsourced basis into the private equity industry. Well, the way that business can grow is let me pick up a outsourced sales operation. Let me pick up a market segmentation operation. Let me keep adding more products to keep selling to my customers.
Yeah, I've already got these customers. They have other needs. Let me just find services that will meet these other needs and just make it a more holistic solution. Yeah, classic. So I know one of the things I wanted to talk to you a little bit about is what happens when things are not going so well, or at least things are not performing as expected. And I know you do a lot of this work, is where you have, an investor or, someone on the cap table who has certain expectations about company performance, has kind of built their financial models on hitting certain targets by certain dates, and the company is just not performing, right? It's not horrible, right? It's not, disaster, but it's not doing what they expect. They're kind of figuring out, what do I do with this thing? The company has some options. There is some future there, but maybe not what they originally planned. And then you've got various players, right? You've got various people on the cap table that may be aligned, may not be aligned. You've got potentially a founder, CEO who's still involved and still, has some equity in the deal. You've got management. How do you deal with some of these situations that are not going as expected, and how do you kind of size these things up, and how do you work with companies to kind of figure out what to do with these assets?
That's a great question, because we do a lot of work in the early stage venture community, and the rule of thumb around venture funds is that there will be one or two investments out of a whole fund that make the fund's returns. They're the 10 or sometimes 20x returners. And a typical fund is going to have 20-ish investments, and let's say that that 10% of them or 15% of them, so 2 or 3 go to zero. Well, that leaves a bunch of investments in the middle that neither took off nor went to zero. And I guess first off, investors have got a bunch of patience. But they are momentum players, and so the people with most momentum are going to get the most attention. So in reality, what's probably happened first is some level of neglect. And then what has probably, and I imagine your founders listening to this will sympathize with the thing, what has happened next is just a more and more tense relationship. In which, let's say, someone hired to run sales just didn't work out. It was a big company sales rep in a small company setting. It just turned out not to be what everyone hoped it would be. And that knocked people off what they thought their trajectory would be by like 2 years. And so now you've got this small business, investor-backed, expectations of exponential growth, and you're now at like year 5 or 6 when you thought you'd be 4 times as big as you are, and you're turning over sales leadership and trying to get it going again. Well, everybody's kind of tense. And so that becomes the first thing to navigate, is how to not let it get you down.
Yeah.
And similarly, how to not engage, of course, your investors in a fantasy at the same time. There's not an investment banker role in that, but it certainly is the reality for the founder as you start to wade through a tense relationship, especially with the money-oriented directors on your board.
Yeah.
And their job, honestly, is to get their money back, right? And so they're going to be the ones who are going to push you most. What I recommend people do most is have some patience and empathy for the money person, who is probably not working for themselves, but probably has other investors behind them.
Yeah.
And appreciate that they actually legitimately need an answer to how will we get this money back?
Yeah.
And if you can deal with that with patience, you can probably keep them in a dialogue. What they're probably going to ask you to do is get a better answer than whatever you gave them at the last board meeting.
Yeah, exactly.
And so what's a better answer? You know, a better answer is more specific about whom. And to the extent possible, it's more specific about when. It doesn't have to be that it's 6 months from now, probably, unless you're burning a bunch of cash.
Yeah.
But it does need to be, hey, we think someone is interested in this way to do this kind of thing, and we've made these sorts of steps towards building a relationship so that that ultimate buyer can see the value of what we're doing in the market. Now, maybe we're competing with them and beating them in the market, in which case they can probably see it.
Yeah.
But if it's something adjacent where it's sort of we both, you know, it's a they win when we win, as opposed to they lose when we win scenario, you know, then it really does become a question of getting out to those potential acquirers, in our view, not with a will you buy my company message, but with a what can we be doing together that creates more value?
So kind of
some kind of joint effort of something.
Yeah.
And you know, and ideally there's some revenue behind that in the short run, but also ideally there's some sense of, you know, we could find tighter ways to work together. Now, what doesn't especially help and does understandably annoy investors is to say that there are 5, but I haven't met any of them.
Yeah.
And I think in theory it would work, but I'm too busy doing other stuff to have gotten around to going to like test this situation. Or worse yet, there are some, but I don't know how many people who could do it.
We suspect there are some people out there.
Right, exactly. We suspect there's some people. So the first thing is like make a list.
Yeah.
You know, who could it logically be?
Yeah.
And then treat it like sales. You know, if you've got a list of prospects, go qualify interest from your prospect. Go out and talk to them.
Yeah.
Find a way to get in front of them with this broad discussion about how can we work together. Then you've got some real input about what you can do.
Yeah.
And I might add at that point, let's say that an investor said, you know, we really need to get on with this, and I want you to talk to an investment banker I know who's done other things for me in my portfolio. You know, that conversation with the investment banker is going to be that same conversation. It's going to be, okay, well, let's go think logically where this company would fit. Let's, through the combination of the investment banker being a participant out in the market and you, the founder.
Yeah.
It's between both of you, come sort of work through, well, what conversations have we had that, you know, in which we can generate some demand for you as a vendor, as a partner, as a, you know, acquisition target.
Yeah.
So you can do it yourself.
Yeah.
Pretty easily, and you should.
Yeah. How do those conversations go, I guess? Like, what's your suggestion or kind of strategy in approaching some of these options? I certainly have seen this. It's like, okay, yeah, we see a couple of like bigger players. We could, you know, maybe we've got a geographic add to them, or, you know, customer base or something. Like, how do you have I just find sometimes it's a little dicey or it's a little
Yeah,
complicated to kind of
it
have these
is.
conversations. Like, what any
Yeah.
suggestions on how you approach this, or what strategies you use to approach these prospects?
I think that there are, generally speaking, two avenues into a bigger company.
Mm-hmm.
The one avenue in is through sort of divisional or product leadership
Okay.
that goes, hey, as you're thinking about how you sell in the marketplace, what could we do that adds something to that?
Mm-hmm.
And the other way in is through finance or corporate development
Yep.
leadership if it's an acquisitive company. There's an asterisk to that if the other company is owned by a fund, of course, you can always go to the fund
Yeah.
because their job is to scout acquisitions. But in the end, it's management's decision, really. And it tends to be the case that if you're running a business that's providing a complementary product to someone else, probably your easiest way in of who you're going to see in the marketplace and see at conferences and so forth, probably is product management leadership or divisional leadership.
Okay.
As you can start to sound out there, hey, is there something we ought to be talking about?
Mm-hmm.
Maybe you get no urgency. The normal place in that that investment bankers network will take someone is to finance leadership or to corporate development if it's a staffed function.
Yeah.
And I think the thing to appreciate in both cases is once it becomes a discussion about some kind of deal or venture or investment, inside the bigger company that you're talking to, those conversations intersect.
Mm-hmm.
So if the investment banker goes into corp dev and says, is this something you'd like to look at?
Mm-hmm.
The corp dev person, whose job is to screen acquisitions and to some extent joint ventures,
Yep.
takes that idea and takes it to divisional management and says, hey, is this something we want to spend time on together? Yeah. If it comes in through divisional management, somewhere down the road, if it starts to become an acquisition like discussion, they're going to go to finance and say, hey, here's something that we think we ought to look at.
Yeah.
So they're going to come together behind the scenes. And if you've got the right team together on your end, if you're close to thinking about an exit, maybe there's an investment banker type on the team.
Yeah.
If not, you've got your money-oriented investors, VC fund types who can sort of play the same role and hit the finance people at the bigger company.
Yep.
And you yourself, as the founder, can go hit product management, divisional leadership.
Yeah, kind of tackle it both sides and see. And what makes those kind of deals work, and what gets in the way of those kind of deals? Like when you actually get into, okay, like how would we combine these things? Like what's the synergy? Where are the obstacles? Like what typically comes up?
Number one is creating a situation that seems urgent enough that people need to act on it.
Yeah.
And I think the right analogy is sales as a starting point, because you say, okay, well, what makes the sales conversation work? Well, I uncovered something about someone's need that was urgent enough they wanted to take action on it. And you could think about these conversations as really being like sales for as long as they're sort of business development conversation. I'm going to do some kind of venture because I can do more than one of those. Once it becomes a sell my company conversation, I only get to sell my company one time.
Yeah, exactly.
And so in that case, the analogy gets a little bit weaker, but it's still there. You've got to find a reason for someone to be attentive, but you've got another lever that you don't have with business development, and that's that you can create some kind of sense of scarcity.
Yeah.
So how do you create scarcity as a way to, catalyze action? Well, you got to have more than one conversation going. Yeah. Right. I mean,
competitive environment.
And you create a competitive environment.
Yeah.
To go back to the sales analogy, sales go better if the top of your funnel's full.
Yeah.
So one way or another, you need more than one conversation going.
Yeah. Yeah. And how does this typically play out in terms of a board, in terms of, is the deal good enough, right? Like various people may have various kind of expectations or levels they have to hit to be able to do the deal. And some people want to stay on and like, hey, let's try for another year or two. We can probably get a better offer. Maybe we can turn things around, versus someone else's like, I just want out because I want to redeploy this capital somewhere else. I have another opportunity that's better. Like, how does that play out typically?
Early on in my career, I had the role of, of staffing corp dev for a publicly traded company. And every single summer, we would, with the help of an investment banker, have a board meeting in which we looked at other M&A deals in the marketplace and our stock valuation and our own business plans. And we prompted with the board a conversation that went, are we serving the shareholders better by selling now or by not selling? So which was the better outcome? I think any time there are professional investors who need to be thinking through that math, some kind of periodic view into that decision needs to happen, which is, okay, it's the right time to do it when selling is better for us than not selling.
Yeah.
And that's going to mean that people have got to have some projection of the future, and they've got to have some discussion about how much you discount it back in order to quantify those things. But in the end, it's going to be the owners, the investors' decision that I'm better off with the transaction now than I am with a transaction later, or just holding. And that relative value is the whole decision.
Yeah.
Now, you brought up an overlay to that, which is the investor's own needs unrelated to the company.
Mm-hmm.
It could be like, well, look, I mean, it might be better to sell later, but I need the money back now. And so it wasn't about, was it better or worse from the company's perspective? It was just strictly from the investor's perspective. I'm at the end of my fund.
Yeah,
I want to
exactly.
close this thing down.
I mean, you always have this on the beginning of the fund. It's like, where are you in the acquisition side when you're selling? That will change people's buy side. Well, the same thing happens on the sell side. It's like
same thing
happens. Hold on,
the
and they may want to do it quickly. Yeah.
And we in my world, we think about where we do some distressed work. We think about distressed companies and distressed owners. There is no catalyst for a deal like a distressed owner, right? Because it has nothing to do with the quality of the company.
Yeah,
it just has to do with the owner needed money.
Yeah,
and or they needed to be out for some reason. Let's say there's some venture fund wasn't raising the next fund, and the staff at the fund, of course, are getting to retirement age. Well, they just want to be out.
Yeah,
they're like, clean this thing up,
get me out.
I mean, because those are small businesses too, right? For the most part. And so I think just being, again, sensitive to that need and empathetic with that need, like they've got their own needs. And sometimes it's just going to force a change really in the cap table. You ideally organize that so it doesn't really change the organization. It only changes the ownership. Yeah. I think it's an interesting one. And I think it certainly comes up on the early side when you do the initial deal, is just understanding the investors and the motivation, where they are on their fund, what are they looking for, what kind of time frames, that goes so much into figuring out kind of valuation and deal terms and how deals are going to be structured and ultimately who you want, right, on your cap table. Right.
So Frank, this has been a pleasure. I know there's probably, another hour conversation we could have on a lot of these things. We're hitting time here. If people want to find out more about you, about the work that you do, what's the best way to get that information? Our
website, which is oaklynconsulting.com, is by far the best way to do it. There are lots of client stories on that website and lots of sort of articles that are tips and tricks. And so I send everyone there. Obviously, reaching me through the contact us portion of the website is a great way to do it as well.
Great. I'll make sure the links are there. And I've looked at several of the articles. Really good stuff there. Highly encourage everyone to go check it out and download the information. There's good case studies and good details there. So thank you, Frank. It's been a pleasure. Thanks for being on the program today.
Well, likewise, Bruce. Really honored to be here.